Hi guys, welcome to my show NKJ Talks for Investment in English. Today in this show, we will be discussing third principle of investing to become a billionaire. And what is that principle? That principle is managing your risk when you invest in equity. How to manage the risk when you invest in equity. First of all, you should understand that there are two types of risk whenever you want to invest in share market. One is systematic risk. Second is unsystematic risk. Systematic risk is the risk which is uncontrollable. It is common to all the securities. Whether you invest in HDFC Bank, whether you invest in Reliance Industries, whether you invest in large cap, small cap, mid cap. It is known as systematic risk because it is on account of macroeconomic factors. It is on account of external factors like political situations, how is the budget, what is the taxation policy, how is the foreign relation of a country with other countries, whether there is a war going on or not. I mean, there are certain factors which affect all the securities, and these factors create or generate a kind of a risk which is known as systematic risk. This means if the overall market is falling, then obviously my stock will also fall. If the overall market is rising, obviously my stock will also rise. So systematic risk results into movement in stocks which is same as that of the entire market, or you can say movement of stocks which is same as that of Nifty. Nifty 50 is basically a correct indicator of a systematic risk. We always say that Nifty 50 is the index which is affected by only systematic risks. There is no unsystematic risk in Nifty 50 because it includes all kinds of shares, all kinds of industries, and represent best companies of the Indian economy. Understood? And the second risk is unsystematic risk. Unsystematic risk is the risk specific to a company. It is the risk specific to a company. You can see recently prices of many shares, they fell down. Although the market was rising, but still certain shares were showing negative results. Were facing fall in price, especially like Reliance Capital, DHFL, Yes Bank. They were going against the market. Although the market was rising, but they were falling. The reason being they were affected by various reasons which were specific to these companies only. Reliance was facing a lot of problem. Reliance Capital, Reliance Infra, Reliance Power, they were facing a lot of problem because of over leverage. They had taken excessive leverage, excessive loans, and they were finding it difficult to pay. So these stocks were falling. Yeah, I think you have understood the point. So let us summarize: systematic risk, which affects all securities; unsystematic risk, which affect a particular security. So whenever you are investing in equity market, you should always manage your risk. Otherwise, what will happen? You will end up in a situation where your entire capital may get wiped off. You know, the first and the foremost principle of investing is to protect your capital. Your capital should not vanish. It should not go away. It should not get absorbed by the losses. There is an utmost requirement to maintain your capital. You may earn less profits. It is fine. But you should not incur loss. Little bit of loss is also fine, but if your losses they keep on accumulating, what will happen? One day your entire capital will get wiped off. This had happened with Reliance Communication. This is the problem with Anil Ambani Group. This was the problem with Vijay Mallya. They had taken so much risk that their entire capital got wiped off. Not with I'll say with Anil Ambani Group, but they are also under a lot of pressure. But if you look at JP Group, they are almost gone. So those people who took unnecessarily excessive loans, unnecessarily they played on leverages, they got wiped off. So it is always suggested that you should keep your risk into manageable limits. That is why I have come with this third, that is why I have come up with this third principle, that is to manage your risk. Right? Now, as an investor, how will we manage our risk in stock market? I'll explain. When you invest your money in Nifty 50 mutual fund, your unsystematic risk is zero. Reason being, Nifty 50 mutual fund reflects the Indian economy. It is only affected by macroeconomic factors. If within Nifty 50, some companies are not performing, then some other companies are overperforming. So the negative performance of few companies get offset by excessive positive performance by other companies. So as a result, almost you can say of all the indices which we have in our stock market, Nifty 50 or Sensex 30 is the best representative of our stock market, and they are affected by only systematic risk. If you take any other index, if you go for small cap index, mid cap index, then the proportion of unsystematic risk will increase. But since they are also some kind of an index, therefore unsystematic risk in such indices also is at manageable limits. Now, how to invest in stock market so that your overall risk is within manageable limits and you are sure that in long run your capital will remain intact and ultimately you will earn good profits. There may be certain periods when you are earning less profits, but again there will be certain periods when you will be earning excessive profits. As a result, in long run you will be earning good profits. So what should be your strategy? That is what we have to discuss today. So whenever you are investing in stock market, kindly do not put all your eggs in one or two specific stocks. It is an old saying, don't put all your eggs in one basket. Why? Because if that basket somehow falls, all your eggs will get lost. You will lose all your eggs. They'll get broken and then you will be left with nothing. The same principle applies to stock market. Do not invest all your funds into one or two stocks. If you are investing in stocks only, specific stocks only, then you should have a good and a large portfolio. Greater are the number of scrips in your portfolio, lesser will be the unsystematic risk. Fewer are the scrips in your portfolio, greater will be the unsystematic risk. You cannot control systematic risk. You cannot avoid systematic risk. But you can avoid unsystematic risk by following a simple formula or simple logic or simple step of diversification. More you diversify, less is the unsystematic risk. In your portfolio, you should include all types of industries, and within each industry, you should have more than 2-3 scrips. So as a result, when you will make a portfolio in which you intend to eliminate unsystematic risk, you will find your portfolio to be a big one with at least 30 to 60 scripts into it. There is no other way to eliminate unsystematic risk. So one way is to build a big portfolio, and within that portfolio you should have shares representing different industries, shares representing different industries, and in each industry you should have more than 2-3 shares so that your portfolio is devoid of unsystematic risk. I think you have understood my point. And a very short way to build up a portfolio in which unsystematic risk is almost zero is to purchase just the shares which are in Nifty. You purchase only all the shares of Nifty 50 except 5-6 if you don't like them. Then your portfolio will have unsystematic risk which will almost be zero. This is the other way. But the problem in this is you will have to track all the companies. You will have to see the performance of all the companies. Number of scripts will be large in your portfolio, so you will find it very difficult to keep track of each and every company. So the other alternative to keep unsystematic risk to almost zero level is to invest in Nifty 50 ETF or Nifty 50 mutual funds. Because when you're investing in Nifty 50 mutual fund, then that amount gets invested in the same proportion in 50 scripts of Nifty. As a result, unsystematic risk is zero and your portfolio will rise and fall on account of systematic risk. And in my other videos, I have told you how you can use different policies, balancing between debt and equity mutual fund to reap out the benefit of fluctuations in prices of fluctuation in levels of Nifty 50 index. That I have explained in my other video, second principle of investing. I think you have understood the point very well. So let us summarize. First thing, there are two types of risk, systematic and unsystematic. Second, you cannot control systematic risk. You cannot avoid systematic risk. It is common to all companies. You will have to face it. But it is in your hand to avoid unsystematic risk. How you can do that? Through diversification. Either you yourself make a big portfolio in which you should have shares representing all types of industries, and from each industries you should have multiple shares of multiple companies, so that your portfolio is well balanced. Then almost unsystematic risk will be zero. And the other shortcut alternative is to purchase or is to invest your money into Nifty 50 mutual fund or Nifty 50 ETFs. So that is the other way. Now, there is a third way also, whereby you can keep your unsystematic risk within manageable limits. Rather than making your unsystematic risk zero, you can reduce or you can bring down your unsystematic risk to manageable levels. How come? There are two ways. One is invest a major proportion of your investment into Nifty 50 mutual fund and the remaining amount into small cap mutual fund, multi cap mutual fund, mid cap mutual fund. That way, by including these mutual fund, you will increase unsystematic risk and there are chances that your returns will also increase. And the second alternative is, if you don't want to invest all your money into mutual fund because that doesn't bring excitement in your body. You know, when you invest in specific stocks, they bring excitement. They give you a lot of excitement. Maza aa gaya. Oh God, I have invested in this fund and this has gone up. I'm enjoying. My decision was right. So that gives you a lot of excitement, and excitement brings satisfaction. In that case, what you can do is put all your money, put at least 50% or more of your money into Nifty 50 mutual fund, and remaining less than 50% of your money you should invest in specific stocks with certain precautions. Number one, if it is a share which is included in Nifty 50 index, then you may invest up to 2 to 3% of your total investment. I mean, total investment is 100, out of that 50 is in Nifty 50 mutual fund and remaining 50 is left. So out of that 50, 2 to 3% you can invest in any specific stock which is included in Nifty 50 index or Sensex 30 index. Not more than that. Second precaution, if you are investing in any small cap which is a very unknown company and whose prices have been volatile in past, you should never invest more than 0.5% or 1% of total investment. 0.5 or 1% of total investment. And if it is a mid cap, a good mid cap with a good history, you can invest up to 2%. But if it is a mid cap, not a very good mid cap, a slightly speculative kind of a mid cap company, then you may go for up to 1% of your investment. So the summary is, of your total investment, invest 50% in Nifty 50 mutual fund. Remaining 50% you can invest in specific stocks If the stock is included in Nifty 50, you can invest in one company up to 3% of your total investment. If it is a mid cap, good mid cap, up to 2%, average mid cap or speculative mid cap, up to 1%. And if it is a small cap, which is speculative, which is not very renowned and which is not very stable, then you can invest up to half to 1% of your total investment into that. And overall, out of the 50% which you are investing in specific stocks, you should invest at least 20% in large caps, very reputed large caps, which are included in Nifty 50. Out of remaining 30, you can invest 15% in mid cap and 15% in small cap. So if you follow this overall strategy, what will happen? You will be able to keep your unsystematic risk in manageable limits. And you will be quite assured that your overall investment will not wipe off in long run. You will earn huge profits or reasonably good profits, and if there is loss in certain scripts, since you hold very good things, it will get offset. So this was the overall idea. Actually, you people sometimes follow the simple philosophy of high risk, high profit. Most of the investors, they believe if we take high risk, we will earn high profit. Actually, high risk, high profit is half of the rule, or is the half statement. The full statement is high risk, more profit, the high risk, high profits, but in case of losses, high losses. Try to understand. High risk, high profits, but in case of losses, it also results into high losses. And sometimes losses are so exorbitant that it completely destroys a person, as it was in case of Mr. Vijay Mallya. Hopefully, you have understood the basic theme of this video. It was to protect your capital so as to keep, how come to protect your capital? By keeping all your risks within manageable limits. Hope you have liked the video. If yes, please press the like button and share these videos with your friends. Whenever you share my video with your friends, I get more likes, more views, and that encourages me to produce more videos, to make more videos for you. I want to bring one video daily for the benefit of my viewers, and in return of that, I want a simple support. Please share and like my video. Bye bye. Thank you.